I just want to get your views, Jeffrey, on what's transpired in the markets in the last few months, and as it relates to the economy as well, and the Fed dependency here. How do you think about the Fed's role in the overall economy and the markets?
Well, the Fed has decided that they want to pull out all the stops to reduce market and economic volatility. I think that was what really got them going in the later part of March and early part of April, was that markets, not just the stock market, but commodity markets, junk bond markets, interest rate markets, were experiencing really persistent and elevated volatility. And they just kept throwing things at it to make the volatility stop. And of course, when investors use the word volatility, what they really mean is down, prices going down a lot. And the Fed came in because there was a total seize up in really the credit market system around the world, but of course, relative to the Fed in the United States. I've been in the market for 35 years, and I've seen all kinds of crises, including I was right at the front lines during 2008, 2009, during the global financial crisis, which really hit the securitized asset sector. And what we experienced in the last part of March was far worse in terms of market conditions in the investment grade corporate bond market, in the emerging markets, certainly in the junk bond markets, far worse than the very worst day in March of 2009. Literally in 2009, you could get a bid. You didn't like it. The prices were in a free fall from the day before on the really ugly days of maybe 10 or 15% price moves to the downside in a single day. But in March of 2020 here, there was no bid. There were actually situations in large swaths of the fixed income market where you simply could not sell assets. And that led to what looked like was going to be some very substantial bankruptcies in some of the leveraged pools like mortgage-related REITs and other leverage types of investments. And the Fed just figured that at desperate times, they required desperate measures, and they went all the way into buying corporate bonds, which, as I've said in my webcasts, is not allowed under the Federal Reserve Act of 1913. And they did not buy corporate bonds during the global financial crisis, even though I know for a fact they talked a lot about it, because I know people that were inside the Fed at those discussions. But what they're doing is really a bridge further than they've ever gone before, where they're not even following their own charter, which means that the Fed could go even further in violation of the Federal Reserve Act of 1913 if they really feel like, we go into another economic move down. So the Fed has propped up the economy with just the most incredible fiscal lending that they've ever contemplated. And of course, I think the listeners know that the quantitative easing that the Fed has done since March is greater than all of the quantitative easing that they started back, in the global financial crisis. It was more in just 3 or 4 weeks than that entire program that was laid out over a multi-year framework. So that shows the level and extent of their commitment.
Yeah, certainly the word that gets tossed around is unprecedented. And you were just referencing your 35 plus years in the markets, never seen anything quite like this. We've talked a bit in the past, Jeffrey, about corporate credit and, the issues that were already there to begin with. How do you begin to assess those issues with the latest Fed moves? And are we just delaying the inevitable here?
Well, in a certain sense, I think we're delaying the inevitable because under my analysis, many bond prices that have been pushed up by the Fed's buying of ETFs and then individual corporate bonds more recently, the prices they've pushed many of these assets up to, I think, is a higher price that they're actually paying for them than you'll receive through a bankruptcy workout when a lot of these companies have to go through a filing. Also, as I talked about in the past, we probably talked about this in our last interview, the fraction of the corporate bond market that's investment grade and is the lowest tier of investment grade, which is BBB, is really enormous. It's basically half, or now even more than half of the entire, it's like a $12 trillion market now. There's been so much issuance of corporate bonds, and the prices have been propped up to levels where I think the owners that own them at these levels will end up losing principal on a basket of these assets. So to that extent, they're delaying the inevitable. In the meantime, they have a lot of wherewithal to continue delaying because they are spraying money all over the place and buying all these assets. The one thing that's happened that a lot of investors aren't aware of relative to their corporate bond activities is at first, it really popped the prices of UD, which is the investment grade ETF, and JNK, which is the junk bond ETF that I followed. And since then, the price of HYG is not really even up since April 9th, when they really went full in. I think they announced corporate bond purchases as a strategy around March 23rd, but they really upped the ante in a meaningful, very meaningful way on April 9th. And since then, those prices haven't really gone up. They fluctuated, but they're pretty much unchanged. Meanwhile, that has led investors that understand that the price of corporate bonds today isn't really real. There's no price discovery mechanism that's being pegged. There's no message. There's just a target price that the Fed has been doing. And that led to a pop up in corporate bonds. But since April 9th, which is now we're moving on to about 3 months, the sectors that were left behind to fight for themselves, like the lower tiers, commercial mortgage-backed securities or asset-backed securities, and some emerging market bonds, they've really outperformed corporate bonds because they're catching up as investors realize that the interest rate profile of investment grade, like the LQD, is very long. I mean, it's about an 8-year duration. So it's about the interest rate risk of almost a 10-year treasury. And yet the yield to no losses is about 2.25. So there's not a lot of reward there. And there's a lot of risk if those bonds get downgraded, because the yields on junk bonds are far higher today than the yields on BBB corporate. So if they get downgraded, we know that the pricing is going to suffer very significantly. So in that way, the rating agencies might have an influence that the Fed can't really offset that easily, because those downgrades lead to probably about a 200 basis point spread widening, which means about a 15-point price drop if the market starts to factor in the potential for the credit quality reevaluated to the downside.
All right, Jeffrey, I want to bring in Brian Chunk to give the latest on the FOMC meeting minutes. Brian, why don't you break it down for us?
Well, Julia, the big headlines from that June FOMC meeting, which took place June 10th, where the Fed did hold rates steady. The Federal Reserve did commit to what they call highly accommodative monetary policy. They said that was needed to support a recovery for a second quarter that the minutes said would likely show the largest decline in economic activity in post-World War II history. On the other side of the coin, the FOMC did see financial conditions improve between the period between its previous FOMC meeting in April and that June 10 meeting. They also pointed to that May jobs report, which, as you'll recall, had the surprise of job gains during that month. The FOMC said that the proportion of laid off workers who expected to be recalled was much larger than they had expected. But even though they said it could have indeed be the case that April showed to be the, quote, trough of the recession, participants said, based on the minutes, that it was too early to draw any conclusions. A number of participants on the FOMC did express worry about the epidemiological path of the virus. A number of them saying that there was a substantial likelihood, was the quote, of additional waves of outbreaks, which in some scenarios could result in further economic disruptions. Shifting gears to quantitative easing, again, their asset purchases of mortgage-backed securities and also U.S. Treasuries. The FOMC minutes did note that they wanted to increase the current pace to, quote, sustain smooth market functioning, end quote. That was something we had heard from Fed Chairman Jerome Powell in that press conference. And then lastly, something if you're watching fixed income very closely, as your discussion was just touching on, yield curve control. This would be further Fed intervention in the medium-term market for U.S. Treasuries. A couple of participants, after receiving a briefing on the idea of capping medium-term, perhaps 3 or 5 year U.S. Treasuries, remarked that it could be, quote, a powerful commitment device for the committee, end quote, but did say it needed further studying, which means the Fed could be getting a little closer to enacting such a policy. But again, a number of Fed officials still saying they need to study the issue a little bit more. So not a done deal. But again, the big headlines out of the FOMC minutes, highly accommodated monetary policy and an expectation for some pretty shocking second quarter numbers. Julia?
Brian, thank you so much for that breakdown. Jeffrey, your reaction to that, and also even your reaction to the yield curve control part of that that just came out. I know it's something you've brought up on your webcast.
Well, I'm glad that the Fed acknowledges that they have highly accommodative monetary policy. It's staring you in the face, of course, and it would be disingenuous for them to not admit that they have really put the pedal to the metal. And they're right that the economic activity, everybody knows this, for the second quarter is going to be terrible. The Atlanta Fed's GDP now shows an annualized decline during the quarter of about 37%. That's actually improved. It used to be more like negative 45%, but that annualizes to roughly a 10% drop off in economic activity for the second quarter. So yield curve control is something that the Fed has been telegraphing. Jay Powell, and I give him credit, Jay Powell, which are words I don't speak very often, that I give him credit, but I give him credit for talking strongly against negative interest rates. And so he says that in the next recession, which of course we're in, that he doesn't want to go to negative interest rates. You can't go to negative interest rates in the United States without a total catastrophe, in my view. So I'm glad he says that. So what's left is yield curve control, which they're talking about, which is just a code word for suppressing interest rates. There's precedent for this. They did it in the late 1940s and the early 1950s at interest rate levels that weren't that dissimilar to where we are today, in a way to help manage the World War II debt. So what's interesting is to watch the 30-year Treasury. I know in the minutes there, Brian talked about the 3 and the 5 year. They already look like they're being pegged to me. They're at very low levels. But what seems to be a little bit left to fend for itself is the 30-year Treasury bond, which has gone up in yield from its low close by about 43 basis points, and from its intraday low by about 70 basis points, which is actually a pretty big loss. If a 30-year Treasury bond goes up in yield by 70 basis points, you lose about 15% or 12% or so, which is a pretty big loss. So the 30-year Treasury bond, if left on its own, will be going higher. And the real signal to watch for is what is the level at which the Fed really gets uncomfortable with the 10-year, but in particular, the 30-year Treasury bond yield. Because the amount of debt that needs to be floated, that the Fed has done quantitative easing, but we have a lot more debt coming. I mean, we keep still hearing about multi-trillion-dollar rescue packages. And don't forget, we have one of the programs, I think it's the $600 program, is running off, I think, at the end of July. And there's other assistance that runs off at the end of the year. And it's going to be a really big question as to how the economy can handle the taking away of direct monetary payments to American citizens that are, don't have any savings and are in economic distress. So if you didn't have the Fed manipulate the 30-year Treasury bond, I think with all the supply that's coming, if we're allowed to actually float into the market, the rate would go quite a bit higher. But there'll be a level at which I think the Fed decides to do that yield curve control and therefore suppress that interest rate. So it's a very tough environment for investors because there are no market signals. There's just targeted assets and targeted prices for many sectors of the market. And the only way to succeed as a fixed income investor is to really, unfortunately, have to put in a tremendous amount of time and energy, and with a lot of people working on it, into the areas that the Fed is not supporting. And when I talk about that, a lot of investors get really nervous because the things that the Fed isn't supporting are areas that have a lot of economic question marks around them, like commercial mortgage-backed securities, like credit card receivable debt. These types of things, I think we all know that some of these forbearance and some of the non-payment is likely to continue to increase over time. And you have to kind of understand that you're likely to take losses from par on some of these securities. The good news is that we don't think the losses you're going to take are beyond what the discounted prices are already, because everybody knows that these sectors are in really big trouble, or at least certain particularly hot spots of them are in truly big trouble, like hospitality, cruise lines and the like. But that's what you have to do. And investors are reluctant to go into fixed income securities when they think there's any risk. There's always risk, of course. But when they can see the risk, they get afraid. But that's why the prices are down. It's the paradox of investing. People don't like to buy low. They like to buy high when the sun looks like it's shining and the sky is blue. And when it looks like there's a hurricane coming, they want out. But the hurricane is priced in when you know that it's coming. And so it's a tough environment for standard investment types. I'm glad that we at DoubleLine have always had sort of a differentiated, more creative investment style, because it's suited to this type of environment better than more traditional or certainly a passive investment style, which looks like almost doomed to fail in the environment that we're in.
Well, Jeffrey, I have so many more questions. We're going to toss it to break. We'll have more with Jeffrey Gundlach, the CEO of DoubleLine Capital, on the other side.
Morning.
What are you doing?
Isn't it obvious?
We're delivering live market coverage and offering expert analysis completely free.
We're helping you make sense of the markets from anywhere you are.
I get that, but what are you doing here?
Nice pajamas.
Really? I say pajamas.
Oh, pajamas, whichever.
Okay.
Yahoo Finance. Watch today on Channel 604.
Welcome to the show.
Let's make finance make sense.
We've been broadcasting from our homes here at Yahoo Finance as we do our part to try to have social distancing and also try to flatten that curve.
If you speak with any expert in economics, in finance, they will all agree that we don't know what to expect.
It's time for us to start to reopen our economy, to start to reopen America, and we protect ourselves by protecting others around us.
Nothing will stop us from doing what we love to do.
This is Autoblog. For over 15 years, our team has covered the auto industry. But here on the Autoblog show, each episode features our favorite videos of the hottest new cars from all over the world. We're drivers, off-roaders, journalists, tech geeks, gamers, filmmakers, and adventurers. This is Autoblog.
My mother used to say a long time ago, whenever there would be any catastrophe that was on the air, she would say, always look for the helpers. Because if you look for the helpers, you'll know that there's hope.
You're watching The Ticker on Yahoo Finance. We're joined by DoubleLine Capital CEO Jeffrey Gundlach, having a wide-ranging conversation just about the Federal Reserve. And Jeffrey, I'd like to get your take, though, on the economy. And we keep hearing about a V-shaped recovery, a U-shaped, an L-shaped, a W, a Nike swoosh, what have you. What is your baseline scenario? What does it look like to you?
Well, my baseline scenario is that a V-shaped recovery, so-called, is highly optimistic, and I don't even think really plausible. What it basically implies is that you can take 20% of the entire workforce, the labor force in the United States, and put them at jeopardy, put them on unemployment benefits, have them produce nothing, and instead receive money that's being lent by the Federal Reserve to buy the bonds, and that you could do that and nothing bad happens and nobody gets hurt. It just doesn't seem very likely to me that you can have that type of hardship roll over the economy, and you just, it's like nothing happened. It's like the Serve Pro economy, like it never even happened. And I just don't believe that. So when I finally started, well, I shouldn't say finally, when I first started worrying about the COVID-19 being a real thing, which was in March, in like the first week of March, I did an interview and I was asked, what do you think about this virus thing? And I said, I don't know what the consensus viewpoint is about how bad this is going to get and what the damage is going to be to the system. But whatever that consensus view is, I want to take the over, that it's going to be worse than that. And when it comes to the economic outlook going forward here from July 1st, by the way, welcome to the third quarter and the second half of 2020. I'm glad the first half is over. I think that whatever the consensus is on the so-called shape of the recovery, I'm taking the under. I think that you cannot have this type of economic disruption and fear that has been instilled in people's psyches. I don't think there's a good appreciation for how much economic fear there is. I can well imagine the people that were making, $70,000 a year and they suddenly got furloughed or laid off, and they look in their bank account and they're hoping to see something there, but unfortunately there was no magic genie that showed up and deposited money, and their balance is still $5. And so they suddenly are looking into an economic black hole. And I think that's a really major jolt to the psyche of those people. And I have a feeling that there's going to be more of that goes on. As I said, these programs roll off, so some of the people are going to start getting economic angst about that. But beyond that, I believe that the people who are making $100,000 to maybe $150,000 might be at risk also in another wave of layoffs, because those people also don't really have any savings by and large, but also the government is unlikely, I think, to come to the rescue for those types of people quite as readily as they did for people who are living more paycheck to paycheck in a real literal kind of a sense. And it just seems to me that this economic situation from a jobs and wages perspective is fundamentally deflationary. We have all of these people that are working and are at risk. And you might decide through work at home and other things that there's more efficient ways of doing things than what we did prior to February of 2020. And I could see that there could be a round of middle management layoffs that come around because people might be revealed for not being that productive. When you're doing work at home, it's more easy actually to tell, at least for me, it's more easy for me to tell who's really doing work, because who's responding to the emails, who's really contributing to the Teams meetings and all that sort of thing. And I just think that companies will realize that they could right size with the knowledge they've gained through this pandemic. And so we could see people who are making $120,000 a year and have de minimis savings, if they get pink slipped, they're going to be in a real panic because there's not a lot of jobs open. They'll probably have a lot of company in people that are in that position, and that will put downward pressure on these wages. Also, we also know that the economy is going to be unevenly affected. We know that big cities are likely to suffer an exodus. We know that prices on apartments and homes in the San Francisco area are declining. We know that that's also happening relative to Manhattan real estate. And that means that other parts of the country are going to start to see perhaps inflow of population. We've been tracking at DoubleLine kind of the showings, the requests for showings of homes in various parts of the country, and it's very uneven. There are parts that are more suburban-like. I mean, it's a reversal of the trend that we had a decade ago. And so there'll be an uneven type of effect to the economy. The other thing that's going to happen that isn't being talked about nearly enough is the states are really in trouble. The tax revenue from the states has completely collapsed, and it's unlikely to improve. And so a lot of these states are going to be looking for, and some of them already asked for, more government bailouts. So there's a long queue of entities that want or need government bailouts, and that's just going to keep further pressuring the situation. So I think that the economy is going to feel the effects of the recession that we're in now for quite some time to come. I think it's very unlikely that we'll get back to our peak economic growth even in 2021.
Wow, it's certainly a confluence of forces that you just highlighted there that are playing into your thesis. I guess, Jeffrey, what does this mean for the social fabric of the country? Does this actually exacerbate the inequality, especially if you step back and look at some of the responses we've seen? We've seen the stock market go up, but we also know not everyone owns stocks.
Well, there's a lot to that question. The stock market is partially up because of all the money that the government has given people who are unemployed. And if you see the commercials on financial media, they've created investment products that are smaller and smaller denominations. There's ones that's called slices, and you can buy $5 of a company, $5, and you can buy a 10 stock portfolio and invest $50. And it's been widely reported, and it's true, that there's been an incredible increase in tiny retail investor activity in terms of the accounts on Robinhood and at other platforms like that have just exploded in terms of size. And I think that's pretty dangerous. One thing that was interesting, at the top of the stock market in February, there was really unusually high call option buying activity by the little guy. But that has been far surpassed at the high of about 3 weeks ago, around June 8th or June 9th, where the number of of call options that were purchased then was fully 50+% higher than the call buying that was happening at the peak in February, which shows that there's kind of a euphoria, weirdly, from people who maybe they would normally gamble that money or about that they're getting from the government, but the casinos are closed, so the racetracks are closed. So instead, you can take a flyer on the FANGs and the Super Six, I call it, includes Microsoft and the like. Without the Super Six, there is no earnings growth in the United States stock market. There isn't any for the past 5 years. If you take them out, it's nothing. And there's no earnings growth at all in small caps. So this is all being driven by price, not by earnings. And of course, earnings have taken a humongous hit. And earnings in the stock market are now about the same as they were in 2016, when the stock market was like a third lower than it is today. So the fundamentals are completely out of sync with how the market's been manipulated, I think. And then we got the social fabric that you brought up, which we've talked about in the past. And unfortunately, I'm quite certain, I predicted this in prior interviews, that it's just going to keep getting worse. And in fact, this triple crisis of the economic recession, the COVID thing, the protests and all that stuff, it's really just the same problem through different lenses. It all fits together. And it also fits together that we've got a horrifically bad presidential election coming up, where, Joe Biden has a real enthusiasm problem. Everybody knows about that. And nobody knows really what his state of mind is these days, because he's hiding out in a bunker. And then President Trump's basic strategy, which has been very successful for him for decades, really, and certainly in the 2016 election, has backfired. His strategy is hyperbole. He likes to take a situation that is pretty good and say that it's great, and to take a situation that's great and to say it's the greatest thing of all time. Like we had the greatest economy of all time at the first part of 2020. No, we didn't. That's ridiculous. It's not even close to the greatest economy of all time. But this time, but in all of those instances, the hyperbole was on the right side of the distribution. It was a good economy. He just called it great. He wasn't saying it was a terrible economy that was great, because that doesn't resonate with people. It comes across as disingenuous. But with the virus, he screwed up, because he's got a situation where the virus is bad and he keeps saying it's going to disappear. It's not really a problem. He's on the wrong side of the distribution. The virus is on the negative side of the distribution, and he's pretending that it isn't on the negative side. He's pretending that it's all pretty good and it's just going to go away. And that's, I think, why his unfavorable rating is going up. In the past, people said Trump's a liar. He was an exaggerator. There's a difference. It's a subtle difference, but there's a difference. Now he's not an exaggerator. He's just changing the sign from a negative sign to a plus sign on that variable. And I think that's a real problem for him. And I don't know if he knows how to get himself out of it. So today I saw in the news that they're arguing. The argument now has become which of these two men is more intellectually challenged. I think they're having a debate on who's more senile. I mean, this is not an inspiring conversation when you have two ancient guys who their debate is centering around which one of them is in a greater slope of mental decline.
Right. Jeffrey, I look at the betting markets. I know you do too. And on predicted, it was Biden beating Trump and also a Democratic sweep. Yet the markets are still going up. And some people think when there's usually a change in leadership that they might go down. What do you make of that?
Well, it's true that Biden's ahead pretty nicely and predicted now. And it's also true, I think, that there's a disconnect between that and the stock market, because Joe Biden and the Democrats broadly, they pledge pretty loudly that they want to increase corporate taxes. They want to take that tax benefit away from what Trump gave corporations. And since earnings aren't going up at all, really, the taxes had a lot to do with levitating the stock market. And if you reverse that, that's going to be a really big problem. I was talking about, you talked the social fabric, and I think that fits into the election. I was listening to this fellow who I think they call him the president of New York Black Lives Matter. His name is Hawk Newsom. And he's actually a pretty interesting guy. And he was talking on a Sunday program, and he was talking about politics and the like. And he was, he's got particular core issues that he hammers home for his sort of constituency. But he started to go off on what he called a tangent. And he said, I don't want to digress too far, but what's wrong here is I don't trust any of these politicians. He said, they always show up about a year before the election and all of a sudden they embrace us and they want our votes. They never do anything for us. And that sounded to me to be not a digression or a tangent. That seemed to me to be really the point. The point is that there are a lot of people that feel that they're not sure what's wrong, but they know that over the last however many years, 20 years, whatever, 30 years, whatever it is, that somehow this economic arrangement is not working for them. And they understand that it takes many different forms. And there's all kinds of data points you can look at, like wealth inequality, but there's other things than that. I mean, these people, this political regime has been in charge for a long time. And it's awful how the investment in America is so uneven, how the quality of education is so uneven. And really, it's just not being addressed. And when I hear the president of Black Lives Matter in New York say, they're not paying attention to us, that starts to sound like a third party to me. I think that if the election were in 2021 and not 2020, I really think there'd be a third party. And one thing to watch on that is the labor force participation rate, the number of people that can have a job, that have a job, is got down. I think it uptick in the most recent report, but it was down to like 52%. That 52% of the labor force was engaged. If that number goes any meaningful amount below 50, you've got a winning third party. It's called the unemployment party. It's called the I'm locked out party. And I think that's what's really happening here. And we've talked about this in past interviews. And I just think that will do nothing but get worse. And we will ultimately, I even talked about civil unrest during this summer in a past interview with you in the context of the conventions for this election. And that's already here. And I think that you were going to see an escalation in these problems as the voices of the unheard remain unheard. Primarily, except for all kinds of sound bites and promises that I've heard a lot of times before, and so have a lot of other people in the American constituency.
Yeah, Jeffrey, one final question before we let you go. One of the things about DoubleLine, even going back to the name of it, it's don't cross the double line of risk. And we have a lot of investors watching, a lot of retail investors too. And what is the risk right now that people aren't talking about enough, aren't paying attention to enough, that they should be more aware of? What is that double line right now?
I think there's a real risk, and it's not imminent exactly. In fact, I don't think it's really in the next few months. But I think there's risk that the dollar starts to reverse into a significant downtrend, because the value of the dollar versus other currencies is greatly affected by the growth in our budget and trade deficit. The trade deficit is shrinking right now because economic growth is bad globally, but it doesn't matter because the fiscal deficit has just exploded higher. I mean, we're up at over $3.5 trillion already in the first 5 months of this year, in addition to that. And a lot of people say, but the dollar is going to go down against what? Because everybody else is doing strange policies too. And that's an okay point, except it misses the fact that what we're doing here in the United States dwarfs the policies, particularly what the Federal Reserve is doing versus the ECB and other central banks. What we're doing dwarfs what they've been up to. We're really carrying the burden here in terms of fiscal explosion. And that, I think, will ultimately lead to a weaker dollar, which means that you might start to see some sort of purchasing power problems. You might also see that the dominance of the US markets will start to fade away and maybe not turn into dominance, but an inferior type of forward-looking outcome. So I think these people that are buying slices of the stock market don't even know what they're doing and have probably lost money already because they probably bought them June 8th. I just don't think they understand that this is not a fixed situation, and there are several more shoes, if not Imelda Marcos's closet full of shoes, to fall on this economic and market situation.
Something that we will be watching. Jeffrey Gundlach, the CEO of DoubleLine Capital, I thank you so much for this great conversation. I know our viewers appreciate it. It's always great to be with you.